Welcome to the Delaware Mortgage Rate Weekly Mortgage Market Update for the week of August 5th, 2013. Hello, I'm John Thomas with Primary Residential Mortgage here to give you your update. Well, last week was a roller coaster ride for mortgage rates. If you look at the bond chart on the screen, you can see in that circled area, that was last week's numbers. The bond started at 100.888, which was just below the 2-week high for the bond, so interest rates were just below their 2-week lowest point. And then from there, the roller coaster ride took off. We sold off a little bit on Monday. Tuesday, in anticipation of the Fed meeting on Wednesday, bonds were up higher, and then they sold off a little bit. But then the fireworks really started on Wednesday. ADP payroll came out Wednesday morning, much better than expected, so the bond market just started tanking. I mean, it sold off. It dropped like a rock. You see the big long tail down. And then the Feds released their minutes of their meeting, which basically said they're not going to start tapering anytime soon, trying to ease the fears of the market to keep interest rates low. So the market responded to that, totally recovered what we lost, and actually ended the day higher. So we had a huge rally on Wednesday, so rates ended a little bit lower. And then Thursday, weekly unemployment came out and whacked the bond market again, so it just sold off big time in anticipation. Everyone was expecting a much better jobs report. We were looking at 175,000 jobs to be created. Everyone was even upwards of 224. So expecting a great jobs report. The market sold off. Interest rates spiked higher. Friday morning jobs report comes out. You can see there, comes out worse than expected. No one was looking for that. Bond market rallies back, takes back all the losses. Interest rates move back down right about where they started the week. Huge roller coaster ride. So we are going to recommend floating your Delaware mortgage rate to start the week to see if we can build on this momentum from a bad jobs report, which is what we were predicting at the beginning of the week. We thought the jobs report would come out bad. If it did, we thought the bond market would respond positively. It did. We may even be seeing the beginnings of a summer rally, so we're going to float this week to see what happens with the market. Now let's dig a little bit deeper into those reports that came out this week to set us on this roller coaster ride. The first one being the jobs report for July 2013. Labor Department released that Friday morning. We were expecting 175,000 jobs to be created, and we were disappointed. Only 162,000 jobs were created. Market didn't like that. Bond market did. Bond market rallied on the news. And this is what we were thinking, because we had a GDP in first quarter, gross domestic product, of 1.8%. We weren't expecting much better than that. Predictions were for 1.1%. Wednesday, that number came out. We came out at 1.7%. So it was better than expected, but that is not a good GDP. And it even revised the first quarter down from 1.8 back down to 1.1. So without gross domestic product, you can't have jobs, and that's what the jobs report showed on Friday. Unemployment, about the same, was 7.6, ticked down a little bit to 7.4, but the labor force participation rate remained the same at about 63.4%. Now remember, that's a measure of how many people 16 years and older that are not in the military actually have a job. And that's only 63.4% of eligible people have a job. That is a 30-year low number there. We need people to get back to work. That's a bad economy. That's why the bond market responded, and that's why rates are staying low. Now, the weekly initial jobless claims came out on Thursday. That was a surprise. Claims were 19,000 claims lower at 326,000 claims, which was the lowest since January 2008. So that's why people thought the jobs report might be better, but it wasn't. So, in the housing news, CoreLogic came out with some numbers on housing with the Case-Shiller 20-City Home Price Index report, and you can see as the chart on your screen there shows that from May 2012 to May 2013 there was a 12.2% in home prices. That's huge, guys. And then if you look from May 2011 to May 2012, it was a negative 0.7 appreciation. So the market changed in 12. And we're doing great from 12 to 13. So the rate in the summer of 12 is when home prices started going up, and we can see that now. The market's continuing. The home recovery is there. It is a great time to buy. If you wait, home prices are what? Going up. So get out there now. Get under contract. In the local news, the next free first-time homebuyer seminar is in Newark, Delaware. That's Saturday, August 17th. That's from 10 a.m. to noon at the Christiana Hilton Hotel. You can register for that by giving us a call in the office at 302-703-0727, or you can register online, www.delawarehomebuyerSeminar.com. Look forward to seeing you guys next week.